Okay, well let's go ahead and get started. Today we want to cover a few things. We want to finish up on the methodology. We want to try to talk a bit about ethics and risks, and then we'll get into jurisdiction, what I like to call the sanctity of the separate legal entity, and of course residency and basis of taxation. For your information, if you're not aware, all of the slides are on the course website, so that in terms of what notes you take, you don't need to pull down what's specifically on the slides. Okay, we talked last time about the fact that methodology, to a large extent, is what makes you valuable. It's not the things you know, but rather how you're able to apply them. And we talked about step one, which was really gathering information, asking questions. And we said that, frankly, that's the most important part of what we do, because as you'll see as we go farther into this course, if the more you know, if you really know everything you should know, 90% of the time, the issues and the answers will be pretty obvious to you. Now, again, as your experience increases, this will be more and more so, but this will not change that basic fact. Okay, so step two is really a very broad thing of understanding the environment you're in. And again, over the course of a career, this level of experience you have will increase. But the point is for you to be aware of what's around you and what part of that environment is. So with that in mind, we really have to look at our own country and the environment of the other country, which happens to be where your client is interested in going or investing. Let me give a few examples of why this can be important. The first item, high potential for miscommunications and obviously wrong advice. So I'd like to give one example, what I refer to as the Tokyo house sale. When I first got to Japan in 1987 and was working on various things, I happened to overhear why I had been brought to Japan. It turned out that one of the major clients, which was a bank, the bank, U.S. bank, had a branch in Japan, and that branch owned a house that I think the branch manager lived in. And just a simple residence. So sometime in the mid-1980s, the bank wasn't doing so well, and they decided this was an asset they might be able to sell, and that made sense because the bank wasn't doing so well. So some of you who may have a little bit of history on Japan will know that there was a real estate bubble back in the 80s, which eventually popped. And the bank decided, okay, well, let's put this house on the market. Maybe we can get a couple of $1 million worth of Japanese yen for it. Well, a bidding war developed, and eventually they sold it for about the equivalent of $25 million. Now, as I said, the bank wasn't doing so well. So, on a worldwide basis, they were somewhere near break even. If the gain, which obviously was almost $25 million, because they'd owned this house forever, their basis was minuscule. If that gain were taxable in Japan, then on a worldwide basis, the bank would have a loss. But if there were no Japanese tax, on a worldwide basis, for financial statement purposes, they'd at least be able to show a little income. Not much, but a little. So this was a rather important issue. Well, at some point at the time of the sale, an ABC, which stands for American Born Chinese, lady working at the bank. She was, of course, considered an American working in the tax department inside the bank. She called up and she said to the Japanese manager who answered the phone, "Is there a capital gains tax in Japan?" "No." So she assumed that was the answer. That was the answer to the question she asked. There is no capital gains tax in Japan. But she went ahead and assumed that meant that there would be no tax on this transaction, and that's what got put into the, so to speak, records of the company at that point. And it wasn't until somewhere near the end of the audit, after the end of the year, when this marginal rate of income for the company is now being looked at, and gee, this is a rather important issue, that somebody realized, well, of course, there's a greater than 50% tax on this transaction, because back then the Japanese combined national and prefecture and local rates were a little bit over 50%. So there was actually an over 50% tax on this thing. And that was the reason that I eventually was transferred from Houston to Japan, which I'm very thankful for, because otherwise I might still be in Houston. But in any case, this obviously was not a happy client because of this situation. Now, the point is, what caused this? Why was there a miscommunication? As I was talking about last week in terms of asking questions, instead of saying, no, there's no capital gains tax, and hanging up the phone, well, gee, why are you asking? Why are you asking? Now, to the Japanese person, who at least knew what a capital gains concept was, he of course knew that there was none in Japan, because of course there is no concept of capital gains at the corporate level. All gains and losses are part of what we might call here ordinary income. There is no difference. So all of it goes into the one pot and gets taxed at that combined rate of over 50%. So, yeah, there's no special capital gains tax rate, just taxed as any other item of income. Now, the person asking the question asked the wrong question, and the person answering the question answered correctly, but gave an answer that was useless to the person who asked it. So, this is part of this environment thing. In other words, what is the environment we're talking about? things can be different between one country and another. Language differences. If you tell somebody from England that you'd like to table something, that means let's put it on the table and discuss it right now. Here, at least it was when I think the language is still the same. To table something means to delay it until sometime in the future. You can get some pretty confusing discussions because of these kinds of differences. So, being aware of these things, you're not going to learn everything there is, in 1 week or 1 year or 2 years. But the point I'm making is be aware of these things. Search for them. Be conscious of what's around you and develop this knowledge over a period of time. Another part of environment is physically. If a client talks to you about China and you realize, gee, I need to know something about China. Well, understand that there are some different regions. There's some different aspects, which, again, is something which you can attempt to learn something about. Whether something's along the coast or something's inland, well, what's the significance of that? These are some things that can be learned if they're important to you. Another country is not a monolith. Is everybody in India exactly the same? Jasmine? No, there's very, very big differences, especially in the food between northern India and southern India. So there's a lot there, and just be aware that there's a lot of differences, and you have to look for them. You have to be aware that you don't know everything and you shouldn't assume things. Another part of the environment which I think is kind of interesting. This is something that the American Chamber of Commerce in China had put out, which was essentially a survey of businesses. What are the problems that they have in conducting business in China? Well, notice that the second, third, fourth, and fifth are really all related to what you might call a lack of rule of law. And one of the items, one of the handout items, which I think was shown for last week, focuses quite a bit on the lack of a rule of law, especially with respect to technology in China. Now, understanding that a client going into China needs to be worried about whether his technology is going to be stolen and how you protect it is important. Now, we may be here in a class talking about taxation, but we can't be focusing solely on taxation. We're helping a client structure his activities, and technology protection is part of that. How we structure something would be rather important. We might not want to suggest transferring ownership of technology into China. You can certainly have differences on various legal and tax concepts. For example, we have a very, very, very flexible contribution to capital concept in this country. It's very flexible. Gee, shareholder puts something in a company, no tax effect, don't worry about it. But in other countries, form can take a very, very, very important place in the movement of assets and value between one company and another. And as a result, you have a contribution to capital without an actual transfer or an actual issuance of new shares to the shareholder who transferred the asset. That can cause it to be taxable income in the company if there's no issuance of shares. Now, we would never think of that, but this is something which you find in a number of countries. So, again, you're not going to learn all these things overnight, but over the course of a career, be looking for these things, be aware of them, and keep them somewhere in a compartment in your mind so that you think of these things at appropriate times. Again, we have some special rules on forgiveness of shareholder debt. Generally, there's not similar rules in most other countries that I've been associated with, and that'll cause income. A couple of other examples. In the U.S., we expect our Congress to be putting together laws which may not necessarily be good, but at least they're thought through in terms of grandfathering or effective date rules so that you don't unduly hurt somebody who has already entered into a transaction. A lot of other countries don't have the nicety of thinking about those things. So, again, something which is a bit different. Sometimes changes can be made just absolutely overnight. There were major changes, this bottom example, in what are referred to as the value-added tax refund rates, which had an unbelievable effect on the economics of business, and there was 12 days notice. Step 3, identify relevant issues. Now again, as you gain experience, I think you will find what I'm saying is especially true, and that is if you do step 1 right, if you really learn who is doing what, where is he doing it, why is he doing it, with whom is he doing it, from whom is he buying, to whom is he selling, all of these types of questions, the issues will pop out at you as if by magic. This is actually the easiest step with a bit of experience and if you've done the first step right. So again, methodology. You're not showing a client what you know, you're trying to learn from a client what their situation is so that you can help that client with whatever his problems are, not with just communicating to him what you know and which may be irrelevant to him. Step 4, obviously, after you've identified issues, do whatever research you need to do in order to come up with alternatives. And then assist your decision maker in reaching conclusions and implementation. And I think the biggest point here is when you are helping your client do that, I mean, very often you'll give presentations in front of a client, or you'll write them a letter or a report or whatever it happens to be that they've requested as to how you work with them. You have to look at the person who's going to read it, or the people who are going to read that document or hear you speak, and adjust what you're doing for that audience. Are you talking only to people from the in-house tax group? If you are, you can be as technical as you want and they'll love you. You can use shortcut code sections in your discussion. You can say words like subpart F and they'll know what that is. But if you're talking to the CFO or you're talking to operating people, they are not going to appreciate you're using language which they don't know, and they are not going to appreciate detail that is technical in nature that they have no basis to understand. Now, in a written situation, I've seen very, very often where you have a group of people that includes both technical tax people and in-house legal people, as well as finance and operating people who are going to read something you're going to write. I've usually found that the best way of dealing with that is to have something which preferably is no longer than 2 or 3 pages long, which all people can read and understand, and then have some sort of an appendix for those who want to technically get into the details. Think about your audience. Extremely important, and please consider this as you are doing the couple of reports that you'll write in this course. I would think that in one of your other courses, you've or maybe through your own personal difficulties with the IRS in your lives, since I think all of you are taxpayers. It's a great honor to be a taxpayer. You've learned some of the expressions which have meaning in the U.S. system. We have quite a large number of sections in the code which deal with these various concepts. And we've got regulations which explain them. So there's quite a bit out there. Penalty regimes in other countries generally are not as, let's say, detailed and complicated as ours are. And especially when we look at Asia, we find a lot more simplicity, and we certainly find some situations where, for example, a penalty is imposed irrespective of whether you have reasonable cause or anything else. It's just that there's a difference between what you put down on a return in your tax computation and what the local tax authority thinks you owe. There's a difference. We will beat on you and apply a penalty. So there can be differences. And the point is that you need to recognize where there are differences with the country that you are working with. Now, are you going to learn this from English language sources? Probably not. But this is one area you need to discuss with local counsel when you are working with local counsel on the local aspects of the client's needs. So understanding local penalty systems is quite important. And notice also the point at the bottom. Tax penalties are normally not creditable under home country foreign tax credit rules. So not only do you have the insult of having a penalty, but it's going to end up being a non-creditable item, which you do not get benefit for. Another interesting part is that some tax authorities, and the Japanese are, I think, well known for this, will specifically leak embarrassing information to the press. Now, is this fair? Well, probably not, but is it reality? Yes, it is. And the point, when we look through some of these differences and this sort of leak to the press, and we'll I think have more slides on this, but well, let me rephrase it this way. When I was working for the most part during my career, the concerns were how much possible tax risk is there. We calculate this much, maybe you'll have to pay this much if the authorities come in and pound on the table and say, we want more. There's an interest element, maybe there's this penalty, maybe not. And that was the end of our discussion. But in the last 10 years, we have seen that tax issues or other issues that can arise within corporations can have much, much broader implications and can affect potentially the very existence of a company in a country. Yeah, here's some examples here, really since the Enron and Parmalat. Does anybody know what Parmalat was? Yeah, it's an Italian company, and what happened to them?
They make like some sauces.
You want to speak louder?
They make milk and stuff and sauces, that's all I know.
Yeah, well, that's definitely true, they do, but does anybody remember why they're up there with in the same line as Enron? There was, as I recall, about $4 or $5 million of missing cash. And again, one of the accounting firms had been auditing them for some number of years and hadn't noticed this. So this was a rather big thing, maybe a bit more in Europe than in the United States, but accounting problems. So the point is that the media that starts talking about these things, whether it's Enron, whether it's Parmalat, the media doesn't understand what they're reporting on generally, because a lot of times these are complicated issues. And if you have some tax issue which gets publicized, the consequences can be far more than just how much extra tax, how much interest, and how much penalty. The very existence of an enterprise can be at risk in that country or even globally. So we really have a different situation today than we have had historically. Most recent developments, The OECD, again, Organization of Economic Cooperation and Development, they have been on a, I guess probably the word rampage is a good description for the last 10 years, roughly 12 years, to increase the cooperation of countries in terms of exchange of information, to try to turn around the bank secrecy rules that have obviously allowed many people who might choose not to pay their fair share of taxes to quite simply avoid paying tax. So again, from a risk standpoint, think about USB, UBS, the United Bank of Switzerland, and the problems it's had over the past year and a half because they helped some number of thousands of U.S. parties evade U.S. tax through Swiss bank accounts. Again, from the standpoint of risk, they have had to pay huge fines, and they've had ridiculously bad publicity because they're giving up the names of their clients, which should be, G-secret information, to the U.S. IRS. That's a concern organization-wide. That's not just a little bit of tax risk here and there. Okay, so there's now just in the past year, there was roughly 300 new information exchange agreements among countries, including a lot of tax havens that previously, of course, had none, and amendments to existing tax treaties to bring the information exchange article in the treaties into line with the current standards that the OECD is pressing. So this has been a very, very major thing, and there's some things on this if you're interested in the course website. Second thing, FIN 48. FIN stands for, I don't remember what FIN stands for. It's, I think it's financial interpretation. But in any case, what it is it's an interpretation of a Financial Accounting Standards Board opinion, Opinion 109, which is the rules applicable to how a company provides for taxes. Okay, last week you'll remember we had an example with Company X, and Company X had, I think, a project, and that project had $48 million of net income under the project accounting, and then we calculated a total of around $26 million of tax against that amount. I don't remember the exact amount, but roughly that. So they had a high effective tax rate. Okay, the issue for this FIN 48 and Financial Accounting Standards number 109 is how do you account for that $25 or $26 million of tax on the financial statements? How do you account for it? Now, let's say that we had done some planning, and it was not that $26 million that we actually paid, but maybe we only paid 15 because we had done some cutting-edge planning. But it was very possible that the authorities might come in and question what we had done and ask for 10 million more, let's say. Well, that 10 million that the authorities have not asked for, that 10 million is an uncertain tax position. We don't know whether that government will come and ask us the right questions. We don't know whether they will put two and two together. We don't know what will happen if this goes to a court of law. So we don't really know whether our real tax is, let's say, 15 or 25. Then there's 10 million of difference. That's an uncertain tax position. So FIN 48 is telling us that if a company is issuing financial statements, then it needs to put into its footnotes as disclosure, or sometimes even accrue into the accounts the full 25, and not just put 15. Now, if you have to issue financial statements which disclose a $10 million uncertain tax position, doesn't that sound like a roadmap for the tax authority to find out what the problem is? And this rule says you are not to take into account in your decision as to whether to accrue or whether to disclose, you are not to take into account the chances of them not coming in and asking the right questions. So you have to assume on a full disclosure basis that they will know everything, and then you make your decision as to what to do with that 10 million. Now, that's a game changer from the standpoint of how do we make risk decisions for companies that issue financial statements. And a lot of your clients in the future are going to be in this position. You have to make decisions not only based on, gee, this is a great idea that will help save some tax, but also learn a little bit about financial accounting and, well, how is this going to end up on the financial statements? And what will be disclosed about this? This has to come into it now. Yes?
Is this a fairly recent rule?
As I recall, it was issued in, I think, 2006 and became effective, I think, 2007 or 2008. So yes, it's relatively recent. And there's relatively little experience at this point with it, but it's extremely important. Now, the last thing, which is just brand new, in January, the IRS announced, here in the US, the IRS announced that, and I'm obviously paraphrasing liberally, they announced, well, you know, since companies now have to do this for financial statement purposes, you know, they should make it easy for us. So what we're going to do is issue presumably a new form or some instructions eventually on how companies that file presumably like a Form 1120, which is the corporate tax return, or a partnership tax return, or if you're running a business on a Schedule C and your 1040, if you have some uncertain tax positions, you have to schedule them out and tell us. And if you don't, we'll beat you over the head when we find it. Now, again, this is, for U.S. companies, a rather important game changer. You're taking away the issue of, well, call it the audit lottery. You're taking that away. You have to come up front and tell on your tax return what's there. So this is an environment which is really brand new. You're going into a brand new environment that did not exist for most of my career. To summarize, the point is the risk of being wrong, even if only in appearance, has changed. There's not only tax risk, there's business risk. from media, from governments. Your judgment and your ability to, I guess just very simply, sniff twice and understand that something might not smell very good if it's in the public arena. This now becomes much, much more important. You may be, of course, totally legal in what you do, but media and governmental authorities don't have that same legal discipline, intellectual discipline, which we apply to things as advisors on tax law. Okay, so your job, identify and understand risks. The second point is very important. Do you really know who inside your client has to sign off on the risks that are being accepted? And have you communicated adequately to that person? So, knowing your client personnel, very, very important. And of course, the bottom thing, which you can't see quite so well, document that you've done so. Whether you're working in-house within a company, or whether you're with a law firm or an accounting firm, document what you've done with regard to informing people of risk. To go into jurisdiction, what do we mean by jurisdiction? Jurisdiction, I think, as you learn it within the law school, is a very complicated thing, very technical area, very interesting area. But that's not what I'm looking at in this course. Okay, why do I say that? Okay, my objective is for you to understand what we find around the world in terms of taxation. I said last week at some point that conceptually, tax systems around the world are pretty much the same. Whether you're in India, you're in China, you're in Russia, you're in England, you're in France, you're in the United States, pretty much no matter where you are, the structure of the tax system is the same. Yeah, the rules are different. Yeah, you can read some because they're in English, others, Japanese law, you'd have a harder time trying to read it. But it's all basically the same conceptually. Of course, many rules are different. If you sometimes see things that are unusual. I assume you have this in India, although I know you have it in Singapore, or the Hindu family unit as a taxpayer. Is that in India as well? I would hope so. In any case, we don't have Hindu family units as taxpayers in most countries, but a few countries have it. So that's a concept which is really quite different. But, gee, what's income? What's a taxable transaction? What's an event that takes place that you have to figure out the tax consequences of? All this is pretty much the same. Now we go even further. Intellectual property law, contract law, shipping law, all of these things are very similar around the world. And if you are coming from a complex system like the U.S.'s, and you are looking at a transaction that is in some other country, well, you're not going to know what the rules are, but you're going to be able to talk intelligently. You're still going to be able to ask those questions that, about who's doing what, where are they doing it, and so on. And the issues that you would find that pop out at you in the U.S., 95% of the time, they're the same issues that are going to pop out at you in another country. Now, yes, you have to use local counsel to worry about that 5%, but the point is you can be part of the process and not just somebody who's communicating questions back and forth. Your judgment and your knowledge are part of the helping the client solve whatever his issues are. Okay, so now to go back to jurisdiction, why are we talking about jurisdiction? Well, as we talk a little bit through various topics, you'll find that jurisdiction is really at the heart of why a particular format of taxation of residents and non-residents has developed, and why you find that basic same conceptual framework in every country around the world that at least I'm aware of. So if we start off with understanding a little bit about jurisdiction, not the details, but just a general concept, and then apply that to how residents and non-residents are taxed, I think it will make more sense as to why those rules are there, and you'll understand better the 871 and 881 rules, for example, on inbound investment into the United States. They won't just be, gee, should I memorize this thing or not, but rather, if you understand the concept, you'll know what they're getting to, and as a result, you don't have to memorize anything. You just know where to look to then, at the appropriate time, read the law to confirm how it works, whether it's the U.S. or some other country. So with that in mind, what do we mean by jurisdiction? And okay, this is country A, this is country B. And let's say that we have an individual sitting here in country A. What ability does country A have over to do things or to direct that individual in country A? Can that individual do whatever he wants? Or does country A have some authority over it? Joey, you look like you're nodding your head one way or the other, and I don't remember which way it was.
Well, if that person breaks country A's law, country A can put him in jail.
Can put him in jail. Can it do anything worse to him?
Death penalty.
Yeah, some countries have capital punishment. You don't want to be a major tax evader in China. It's a capital crime. Some number of tax evaders have lost their head. This is serious. Okay, so country A has full ability to control this person. If this person has income, country A can make him report it. If this person has expenses, no matter where incurred in the world, country A has the ability to say, account to me for all of your expenditures, so I will know how much net income you have, on a worldwide basis. Okay, so country A has that ability. What if we have not an individual, but we have some sort of legal entity? Let's assume a corporation. What ability does country A have to control that corporation which is established under country A laws? Do you put a corporation in jail? Maybe that's a little difficult, but what about dissolution? Is that the equivalent of execution? Yeah, maybe so. Certainly, a country A can fine that corporation. Let's say that there are some, of course, directors and officers of that company. They could be put in jail. Okay, so in this case, we can see that country A has an ability to fully exercise its authority over the individual and the company which is formed under its laws. So that's jurisdiction. Country A has full jurisdiction over those parties, those persons. So I'm not getting into any sort of technical detail with regard to jurisdiction. Jurisdiction is just what is the power of the authority of that country to exercise some form of power over people and legal entities. Okay, now let's say that there's an individual over here and there's a company over here in country B. We know that country B has all this power over the individual, and let's say that to make things a little easier, let's say that this one is X and this one is Y, and this one is W and this one is V. Now, okay, B has all this authority over V and Y, but what about A? Does A have any authority, any jurisdiction over V and Y? Do we know enough yet to answer the question? Do you have any questions, Andrew?
Is V or Y doing activities in
Ah, okay. Is V or Y, do they have any activities in A? So let's say that V, let's say V has put money into a bank, has put money in a bank and is earning interest. And let's say that Y has put an office with people in business activities. Okay, so to what extent does country A have an ability to exercise jurisdiction over V and Y?
To the extent of their activities in the country.
To the extent of their activities or their assets within the country. Or to the extent they have a source of income in the country. So let's say that in addition Y happens to own some technology, and Y has licensed that technology to X, maybe there's no asset in country A, but there is a source of income. There's a flow of payments every month or every quarter or annually based on the license agreement. So the point is, yes, that country A has limited jurisdiction over activities, assets, sources of income in country B. I'm sorry, of the non-residents of country A, of V and Y. Now, let's keep this basic thing in mind, and now let's go back and see if I can cover some of the materials in the slides. Okay, so we're saying jurisdiction, practical concept. Where and in what situations can a country effectively enforce its laws? Now, you sometimes see situations that by their nature are practically unenforceable. So a couple of examples that I've run into over the years. In Japan, and I don't think the law has been changed since I came across this, if I travel into Japan for even just 1 day on business, technically 1 day's worth of salary is taxable. Well, that's kind of hard to enforce. So it may be on the books, but it's not something that very many parties take seriously. Another one, Indonesia. Again, I don't know whether anything has changed there, but when I practiced in Singapore, and I was talking with local counsel in Indonesia, in Jakarta, sort of the automatic response, no matter what the question was, if they step 1 foot for 1 day, that's a permanent establishment, and Indonesia will tax them, period. I mean, it was sort of like a broken record, hearing it over and over and over. Well, it's not something that can be enforced as a practical matter. Now, from the simple diagram which we put on the board before, you see there's a difference, in a sense, between the ability of country A to tax people or entities that are within its borders, and the ability of A to tax people or entities which are outside its borders. And that has been the basis for this concept of taxation of residents and non-residents. Residents and non-residents. And what we'll do is, over the next, I guess, 45 minutes or an hour, is talk about how residents and non-residents are generally taxed. We'll also eventually get into the question of, well, what is a resident? What is a non-resident? Okay, as we saw from our discussion on the chart, a country can grab from its residents all their assets and sources of income worldwide. Very practical. And, of course, jail and potentially capital punishment. And the mechanism, of course, is the governmental authority, court systems, and so on. From a non-resident, as we said, assets and sources of income, business activity that are within the country. And governmental powers generally do not extend beyond the borders. Let's digress for a moment. What is the border? Okay, this is taken from the 2003 U.S.-Japan tax treaty, but you'll find something pretty similar in most treaties. And notice that although, let's say, the U.S. has a geographical limit of, what is it, 12 miles? In other words, the geographic United States, isn't there a 12-mile limit, something like that? Well, different countries have different things. I've seen where some countries will have a 100-mile limit or a 3-mile limit or whatever. But there's what legally is the country. Am I standing inside country A or not? And maybe the question is, am I floating because I'm in a boat? Or I'm on an oil rig. Am I in this country or am I not in this country? So probably 3 or 4 times over the years I've worked on clients where the real issue is, gee, is what I'm doing inside the country or not? Anybody know where it is in the U.S. Code, the definition of what the United States is? If I remember correctly, I think section 638. So the point is, understand that you just don't assume that there is a border. Sometimes where that border is important. If you're fishing, but outside the limit, but still over the continental shelf, are you in the country or not? Maybe, maybe not. Okay, now let's do what I'll call a short case study. And read through the facts and the question. X, we said that X has set up a new subsidiary Y, and we said that, if I'm not mistaken, when X has orders from customers in country C, X sells its products to Y, which then in turn sells to the customers, and Y realizes gross profit. So we have customers over here. So we're going to have a sale to Y, and then Y is going to resell to the customers. And our question is whether country A can grab the gross profit which is within Y. Now, let's say that X's cost of manufacturing is 60. Let's say it sells to Y at 80, and then Y sells to the customers at 100, so that there is profit in here of 20. the bottom of the slide was the question, do you need to ask any questions? Any questions you would like to ask me about this situation before you can analyze whether A can attack the profit of 20 inside Y? Yes, Peter.
Is there any kind of added value taking place in Y?
Okay, excellent question. Now, the way I'm going to answer this is that I am looking at a spectrum, and I am going to go to one end of that spectrum and answer the questions all at one end of the spectrum. Then after we discuss that, I'll say, well, what if the answers were over at the other side of the spectrum? How would the answer change? So, I will answer that there is absolutely no value added by Y.
We can do the jurisdictional tax issues about, because it just said that one was subsidiary, Y is probably a controlled foreign corporation.
Okay, let's take one step at a time. You're going in the right direction, absolutely. But I'd like to first stay away from, in a sense, tax results and ask physical questions. What's going on? Who's doing what? Where are they doing it? Remember, we talked about, in methodology, we talked about people, assets, agreements, what else? What am I leaving out? Financial flows. Anyway, those kinds of questions. And let's stay away from, for a moment, from where you're going, which is the right place, but premature. I said no value added. Okay, what other questions can you ask? Personnel. What about personnel?
Okay, is this just a shell company? Is there anybody working on it that is funneled it through?
Probably from country
Is there
A.
any physical presence to be?
Okay, good question. First of all, you're asking, are there any employees in Y who are doing something? Good question. And I'll answer no, there are none. Now, are the people who are the employees of Y the only human beings we're concerned about? Are there any other human beings that might be relevant to Y?
Any of company ex-employees are actually doing and contracting business?
Okay, excellent. Are any of the employees of X, are they conducting the business of Y? And yes, I will say that there are some number of people in X who are going out, finding the customers in country C, who are arranging the paperwork for it, and they're all doing it up there in country A. Are there any other human beings we're concerned about? Do you think that Y has a board of directors? Okay, so who are they and where are they? And what do they do? Okay, so we might say, well, gee, there's a director in country B, and you say, well, gee, who is he and what does he do? Well, he's paid $1,000 a year, and he's one of the lawyers at a local law firm, and he does absolutely nothing other than a few formal filings. And let's assume also that several of the people back here at X are in fact directors of Y and make management decisions as to what Y will do. Board of director type decisions. Okay. What about, we're talking about sale of product. Okay, so we might, what's another question with regard to the products?
Does X manufacture the goods?
Yes, X manufactures the goods.
Are the products even going through B, or are they just going A to C?
Okay, good question. What is the flow? The physical flow is from X's manufacturing facility directly to the customer, so that's the physical flow.
So does Y have any sales force in C?
Has no employees, has no sales force anywhere. See, again, I'm giving answers at one end of the spectrum. We'll then go to the other end and ask some of the same.
Is there a sales contract between X and Y?
Absolutely, it's beautiful. We have a wonderful distribution agreement between X and Y, and we'll of course talk more about distribution agreements later on during our course. But yes, there's a beautiful piece of paper, nicely signed, covering the overall relationship. There are beautiful invoices for every sale from X to Y, showing the price of 80. And there will, of course, also be invoices and, as appropriate, contracts between Y and each customer. And again, because all of the human beings who are doing work on this are back at X, all of this paperwork is generated, signed in country A. Okay, now I think we've covered enough at this point to start asking this, to now focus on this question of, does country A have any jurisdiction, and how does jurisdiction govern the mechanisms that will allow country A to attack that profit in Y? Yes, Andrew.
You can't directly go after Y, but through X, and X has all its assets, and equal whatnot in country A, and has jurisdiction over that. So.
Okay, I agree completely with the one exception of the first thing. You said it cannot go after Y. We'll go back to that. But let's stick with the broader thing you said, which was attack X, because X is easy to grab. X is there. X is easy. Okay, so having said that, what are the mechanisms by which A is able to attack X on this situation? Now, you mentioned first, go ahead.
Possible controlled foreign corporation.
Okay, let's take them one at a time. Okay, you've mentioned CFC. And let's label this under the attack X side. So CFC, okay, what does CFC mean? Is that a term that everybody knows, controlled foreign corporation? Okay, so the point is X owns Y. X controls Y. And controlled foreign corporation rules, which structurally are very similar around the world, although they vary a lot in terms of what profits will be brought back up. The basic structure is country A can attack X and tax X as if Y had paid a dividend. So country A can say, Well, I don't care that the 20 is down in Y. I will pretend, we will create a legal fiction that you have received a dividend, and as a result, X, your taxable income is now 20 higher. And you find this CFC legislation, subpart F in the United States, around a lot of countries, simply because it's easy for a country to attack its own residents. And not only in the sense of attacking them when they do something wrong, but to actually put it in the law so that the authorities don't have to go and ask X for it. X has to file its tax returns reporting that 20. Okay, so this is number one, CFC. Any questions on this one first? Okay, what else? Since we're attacking X first, what else could we do in terms of attacking X, a mechanism that country A can use to attack X?
Can country A just say it's a sham and say, okay, we're going to consider the transaction as a $40
Okay.
gain?
Yes, to recharacterize the transaction under, let's say, a substance versus form concept. So yes, that is one that more and more countries are starting to attract.
Going from the point that he was making, they seem to be related organizations, so a transfer pricing mechanism, like an
Excellent.
arm's length pricing.
Excellent. That is exactly right. Transfer pricing. Okay, let's put over here to attack Y. What approaches might there be? What mechanisms might there be?
Go to their board of directors, their country A.
Okay, since the board of directors is in country A, a lot of countries will treat the corporation, even though incorporated outside of the country, will treat that corporation as being resident for tax purposes in country A. So, to label it a resident, and once a company is labeled a resident of country A, now you apply the tax rules of country A just as any other country A corporation or legal entity. Now, going back to our overriding thing, jurisdiction. If all the individual directors are in country A, they are subject to whatever country A's laws and enforcement happens to be. And yes, they can be put in jail if they don't cause Y to act like a proper tax resident of country A. So jurisdiction allows us to include as a resident a corporation that's outside of the country, but that is effectively managed and controlled, and that's the term you find in various countries' laws, that is managed and controlled within the borders. Okay, so now we have residents. What else? Because Y, the activities of Y are being carried out by human beings who are physically at a place of business inside country A, using U.S. terminology, Y has a trade or business inside country A. Using the terminology in most treaties, Y has a permanent establishment in country A through which business is being conducted and income is being earned. So the activities cause, let's say, a permanent establishment in country A, and that permanent establishment now is within the taxing jurisdiction of country A. There's enough people, enough activities to be able to force Y to declare how much income it has. And when there's enough that, as you'll see in later discussion, when there's enough activity that there's a permanent establishment, in other words, the activity rises to a minimum level that we define as a permanent establishment, there's enough jurisdiction to force Y to not only say what its income is, but what its relevant expenses are. And we will find that where there's a PE, then country A will normally tax on a net income basis. A net income basis in contrast to a gross income basis. All of these mechanisms, again, arise out of this concept of jurisdiction. What does a country have the power to enforce? And as a result, we do find transfer pricing rules in most countries today. We do find CFC rules in a number of countries, not all certainly by any stretch of the imagination, but a growing number of countries have CFC rules. A growing number of countries have anti-avoidance rules, or if not an anti-avoidance rule, it may be in the court system a substance versus form concept, or other ways of attacking and recharacterizing transactions. And a lot of countries, not the US at this point, but a lot of countries have this residency based on where the directors are and what they're doing. And finally, if there's activities of employees or agents, a permanent establishment. So these are the mechanisms which you commonly find around the world. And if you, again, think in terms of this jurisdictional concept, they all make sense. They're all there because of a very practical reason. What can a tax authority grab? This next topic is what I like to call the sanctity of the legal entity. Now, here in the U.S., I think we have a certain sloppiness in a lot of companies. Why? Because there's a feeling because a lot of companies file, or let's say a lot of groups of companies file consolidated returns, that there's really not much difference whether something is in one company or another company. And as I think I said last week, operating people don't necessarily think along legal entity lines. They normally don't. They think along divisional lines, or product lines, or service lines, something that's relevant to them, not along legal entity lines. Yet, if we're looking at state taxation in the United States, or we're looking at taxation in most other countries, there are no consolidated returns. It's not always true for state purposes within the U.S., but generally there's not consolidated returns. Each company is a separate legal entity and has to be treated as a separate legal entity. It's very unusual for the corporate existence of a company to be ignored for tax purposes. I think I had said last week that the people behind a company really have to do things absolutely terribly in terms of documentation and how they act for the corporate existence to be ignored. And that's even stronger for other countries than it is in the United States. And another thing is that other countries tend to greatly respect local company law and organizational statutes. Here in the United States, I can honestly say that in the total of 11 years that I have practiced within the U.S., I don't think I have more than once or twice looked at corporate law in the particular state of incorporation of the company that I was concerned about. I mean, it's there in the background, but it's just something that nobody really pays much attention to. In other countries, this is not the case. What a company can do or not do is going to be very importantly affected by a local company's law. So it's something that can be just as important as the tax law itself. Talking about separate entities, and let's assume a two-member group, X and Y, and again, assume that they are either commonly owned or one owns the other. We're just not showing the ownership line on the chart here. And let's say that X buys raw materials and supplies, presumably also employs people in the manufacturing process, and then makes an intercompany sale to Y. Y employs people in the sales area and sells to third parties. Now, we see, obviously, in real life, a lot of situations like this where there's an intercompany sale. Now, if there's an intercompany sale, we're going to see an invoice, maybe a sales contract. We're going to see X account for a sale to Y. We'll show sales income, we'll show cost of manufacturing, and then Y will, of course, on its in its documents, will have sales contracts and invoices with third parties, and it will show that as its revenue, and as one of its costs, there will be the cost of inventory purchased from X. So that's a typical thing we see. Now, is that the only way that we might structure the situation where X is doing manufacturing and Y is doing sales? Is that the only way we can contractually set up this arrangement? Or are there other things that we could do contractually that accomplish exactly the same thing?
You could have an agent.
Okay, so Y, you're saying, could be an agent. X could be a principal selling directly to customers through Y's efforts as an agent or commissionaire. As a result, X sells directly to third parties and pays a sales commission. Now remember, before we said that the structure was X is selling a product to Y which resells to the customers. Y earns gross profit from sales. Total income, total revenue from the third parties minus the amount it pays to X for its product, it earns gross profit from sales. But now we have changed the character of the income that Y will report. Y will report a commission income. Has anybody ever looked at, just to use an example, at a Form 1120, which is a U.S. corporate income tax return? Somewhere at the top, I believe there are boxes for, I think, total assets and total revenue. Now, if Y is making purchase and resale, that revenue is going to be very high, relatively speaking. If the commission, which might be equal to that profit element that Y was making from revenue minus cost of product purchased from X, that difference might be exactly equal to the commission, but now Y is reporting as its income a much lower number. And that lower number has a different character. Services income is not the same as gross profit from the sale of product. Now, we're going to talk a little bit more about that later, but the point is, we have just changed the nature of the type of income which Y is earning. And as we'll see, maybe the nature of that income gets taxed in a different manner. So this is something that is within our control if we are in a group of controlled companies. We can do the manufacturing over in country A, we can do the sales in country B, and we can choose whether or not we want X to sell direct to the customers or to sell through Y. We can choose that. We can do whatever we want there. Now there's a third approach, which is contract manufacturing, which now Y is the principal. Y is paying a service fee to X to perform some manufacturing services on its behalf, and then is selling directly to the third parties. So we've got flexibility to do any one of those three. Now, any thoughts as to why we might want to do one or the other? What if country A is in a very high-tax country, and country B is in a lower-tax country? What in a case where X is getting a service fee and Y is the one selling to third parties, which company is taking credit risk with regard to the customers? In other words, whether the customers might not pay their bills on time. Yeah, Y is normally going to be taking the credit risk. Now, if Y is taking the credit risk, and if X over here, especially because they're part of the same group, has no concerns about Y eventually paying its bills, that means that Y is in a riskier position and is entitled, under good concepts of value transfer pricing, to take a relatively higher share of the profits. Who owns the intellectual property with regard to this manufactured product? Well, we don't know, but if Y happens to own it, or if somewhere else in the group it's owned and Y is the one that licenses it, now you have, again, more value in a sense within Y, and we can, as much as possible, push that service fee, relatively speaking, down in order to have a lower level of profit within X in country A. So the point is, by recognizing that these are separate entities and that in a controlled situation we can define contractually in any way we want the character of income, the amount of risk that each entity bears, we can draw whatever we want. We can structure whatever makes sense from the standpoint of the client and his business. So, for example, make this look like China and Hong Kong. You find a lot of situations where a manufacturer in China is realizing a very small profit level, but that manufacturer is not taking much in the way of commercial risk. And company Y in Hong Kong, or somewhere else outside of China, is either owns or is licensing the IP, the intellectual property, is taking credit risk, is being responsible for advertising, etc., and takes the lion's share of the profit. And it's supported by good intercompany pricing analysis. So the point is, understand what your client's doing, and then you can draw a picture which ultimately ends up giving the best answer. And as when we had Andrew last week being the tax authority, this is what we show him after we've done our analysis and after we've set it up. And under normal circumstances, he accepts what we have created. Now, of course, you might have a situation where X and Y are not related, and then real business issues come up. And it's not our normal monkey business of trying to structure something which works best from a tax or other legal standpoint. If they're unrelated, yeah, X may wish to fully control sales, and as a result, he wants an agent relationship, as opposed to something that is giving too much power to Y. And yes, Y may own the production intellectual property and just want to have a third-party manufacturing at low cost. So these are typical real business reasons which you see between unrelated parties. But the beauty of this is, in a controlled situation, this really doesn't matter. You can set up what you want, and under normal circumstances, if you dot your I's and cross your T's in terms of the form and the contractual relationships and how you conduct your transfer pricing to reflect the risks and responsibilities that each party is bearing as a separate legal entity, it is respected. Okay, so this is saying what we've already covered. Each arrangement allows you to control the character of the income. And again, you'll find that different character of income will be taxed in a different way. Let's now start chatting a bit about residency and why it's important. And we'll talk about, first, about the basis of taxation and the rate of taxation, and then we'll say a little something about tax treaties. In other words, this is why residency is important. If you think back to your inbound course, and you think about how a non-U.S. person, be it a non-resident alien or a foreign corporation, is taxed in terms of the effectively connected income concept, where there's a U.S. trade or business, or on a withholding tax basis. This is the area that we're talking about in terms of talking about basis and rate for non-residents. And of course, again, looking at the U.S. system, it's residents taxed on worldwide income, and there's a foreign tax credit. So this is that area that we're getting into now. So for residents, we find a couple of things. U.S. and China, and I think the Philippines, and certainly plenty of others, have a worldwide basis. No matter where I work around the world, I have the honor of being a U.S. taxpayer. It's a great honor. And as a result, I file my 1040 no matter where I live in the world. I file it to the U.S. and I report 100% of my income on it. So, worldwide taxation. A number of countries, and certainly two that are very important in the Asian areas, the Hong Kong Special Administrative Region and Singapore, both have territorial systems. India essentially, I believe, has a territorial system as well. At least I remember it used to.
I actually don't get the difference here. When we're saying worldwide income, we are talking about companies which are incorporated within the boundaries.
Well, no, not necessarily. Remember, we haven't yet defined what a resident is. We'll talk about what a resident is later. But if we look at the U.S., in a sense, a resident is a company established under U.S. laws, or an individual who is either a citizen or who is a resident under the definition in, I think, 7701B, if I remember correctly.
In India, they have the residency and non-residency concept.
Right, and how do they define resident?
I can't recollect.
Okay,
but
well,
for companies, it is incorporation and the central seat of management.
Okay, good. That's right. So a number of countries, yes, have exactly that. A resident is a company which is controlled and managed within the country. Some countries, the UK up to a certain time, had solely that as the basis. Singapore, I believe, still has it. So that the definition of resident is not a company incorporated in this jurisdiction, but rather any company which is managed and controlled in Singapore. Now, at some point, the UK and I believe Australia also changed their management and control concept to one of a resident is a company which is incorporated within the country or managed and controlled here. Remember in our example before when we looked at Y and said all the directors were in country A. And we said that country A, under it, if it chooses, can define resident as a company that's managed and controlled inside country A. Factually, it was managed and controlled there. Therefore, it's resident. And taxable on whatever basis they're taxable on. If it's worldwide income, fine. If it's territorial, fine. So we'll go back to what is a resident a bit more later, but let's just now have a dichotomy of residents versus non-residents. Now, notice that residents are normally taxed on a net income basis. Again, some exceptions, but the general rule is net income basis. And why is that? Why does that make sense? A resident is subject to the full control of the country. That country can grab that individual or that resident company and force them to disclose worldwide income, or all income that's subject to tax, and related expenses. So there's the power to get all that information. And from a fairness standpoint, net income is your best measure of how much somebody can afford to pay the tax. So we find residents, by and large, being taxable on net income, not gross income. Now, we obviously see some variation around the world in the calculation of net income. Here in the United States, we have this terribly obnoxious, thick, with very thin paper, Internal Revenue Code. And what are we up to? 6 or 7 volumes of the regs. If you think about your Internal Revenue Code, that code defines within it all of what is income and what are expenses. You can figure that out from looking at the tax law. You don't have to go to any other rules. You don't have to look at generally accepted accounting principles in the United States to determine what your taxable income is. It's defined in the statute, in the tax law. Well, that's not the only way it could be. A number of countries will say you start with statutory net income under the company's law or under local accounting law, whatever there happens to be. More and more countries are adopting what are called international financial reporting standards. And sometimes that, or some other local form of generally accepted accounting principles, will be the basis, and the tax law might include only a few minor adjustments, like changing from book depreciation to tax depreciation, or disallowing certain non-deductible reserves, or things like that. So this basis of, is there a separate tax computation in the law versus one that's based on accounting income? Now, this can be important not only from just, gee, how do we do it? But what if you're talking to your client, and you're telling your client, hey, you know, I've got this great idea which will save you so much money. So, wow, tell me. And you tell them, and you also have to tell them, well, because in your country, in order to do this, we also have to book it in the financial statements of the company. And he responds, you mean my net income for financial reporting purposes is going to go down by 50% because of your wonderful idea? I don't think it's so wonderful. So there can be more than just a tax consequence, especially when you're basing something on accounting income. Because if you have to change the books and records of the company to be consistent with your tax reporting, and that leads into your financial reporting to creditors, to shareholders, to others, that can be a major, major concern. I certainly saw a lot of that kind of thing in Japan when I was there. Because again, taxable income was coming really from what was being done on the books and records of the company under the commercial code and certain accounting rules. A lot of countries do not necessarily have a separate tax treatment for capital gains, as my example about the house in Tokyo indicates. It's the same thing in China. There's no concept within the corporate sphere of a capital gain and loss. It's just an item that's included in the net income of the company. Here we have a major issue as to whether something's a capital item or not, because we have limitations on capital losses. I'm not sure about today, but various times in our history, at the corporate level, capital gains have been taxed at lower rates. So it can be very important. Distributions. Does anybody know what earnings and profits are within the U.S. system? Has anybody studied Section 301? What's a dividend? Yeah, dividend is only payable out of earnings and profits. You have to have earnings and profits or you don't have a dividend. Well, earnings and profits is sort of a half tax, half economic concept. Other countries don't have this concept. You either have accounting income within whatever the local legal sense is under the commercial code in Japan or company's law somewhere. If you don't have that, you can't pay a dividend. Here we have a dichotomy between a divergence between a distribution out of a company and its characterization for tax purposes. In most other countries, you can't physically make a payment unless you have retained earnings in an accounting sense, because they're looking at the company's law or commercial code or whatever it is. So this is a difference and can be very important. So there's a number of issues like this where there can be differences country to country. But the basic overall conceptual framework is still the same. We're just talking about really small variations in how income or expenses are computed. If you understand what income and expenses are and how you get the net income and apply a tax rate in this country, you have a pretty good sense of how it's done in most other countries. We've talked a little bit about residents. Residents are the easy one. Because, again, you're subject to the full jurisdiction of the country. For non-residents, it's pretty uniform around the world that you divide up the non-residents between those who have no permanent establishment, no trade or business within the country, and those who are, in fact, conducting business through a permanent establishment. And again, a lot of countries do have this concept of permanent establishment in their laws, and it's a much higher level, and we'll talk about what that means later, but it's a much higher level than what we have in the U.S. In the U.S., you don't have to be doing very much for a non-resident to have a U.S. trade or business. Okay, so first looking at the no permanent establishment thing. Okay, what's included in the tax base? Typically around the world we see interest, dividends, and royalties, and occasionally gain on shares of real estate as being part of the tax base. And notice sales of inventory and other business income like services and such generally are not taxable. Do we have a particular expression in the United States that you find in was it section 1441? Other fixed and determinable annual or periodical income. Does that sound familiar? Does that ring any bells? Okay, so U.S. defines it quite widely. Why would we think that inventory and other business income is typically not taxable if there's no permanent establishment? Again, think back to this concept of jurisdiction.
Difficult to collect.
It's difficult to collect, right? And is anything else about it difficult? It's difficult to calculate. If the foreign person has so little activity within the country that they don't rise to this level of a permanent establishment, then it's kind of hard to force them to give you all of the information necessary for calculating income and expenses. It's kind of difficult, and it's not exactly very fair to tax them on some flat percentage basis of the total income because maybe they had a loss on the transaction. Sales of inventory and services income, there's normally a lot of expenses related to there, and you don't know whether they're low margin items or high margin items. They might have only a little bit of profit, or they might even have a loss. So it's not exactly very fair to hit these kinds of income if you don't have full information of income and expenses. So generally, they're not only hard to enforce and collect, but they're hard to calculate. And if we look at these other items, interest, dividends, royalties, gain on shares of real estate, especially with the first three, there's not much in the way of expenses. There's not much in the way of direct expenses. Now, in theory, you might have interest costs allocated, but normally there's not a lot of expenses. And on gain on shares of real estate, if you define the tax base as gross income being the gross proceeds less the cost of the asset being sold, again, there's normally not much in the way of expenses. So that's what we find in common about the one type versus the other type. Okay, so what's the mechanism? Well, we certainly find in the U.S. rules, your section 1441, 1442, withholding rules. Remember our picture over here, if the individual in country B is earning interest from a bank in country A, it's a lot easier to beat on the bank, which is within the jurisdiction of country A, easily within the jurisdiction. It's a lot easier to beat on your own resident to withhold on payments that it makes to somebody overseas. It is physically easier. And as a result, we find around the world withholding taxes on dividends, interest, royalty, and sometimes on gains on sales of securities or real estate. And that mechanism of withholding is there because of jurisdiction. It's easy to collect. Okay, what about the tax rate? Now, the U.S. is a terrible example in this, but I'll still ask the question, what's the withholding tax rate of the U.S.? Anybody remember?
30%.
Yeah, 30%. The U.S. is at the top end of the scale. Most countries will have somewhere between 10 and 20% withholding tax on this type of income. The rates on net income, as opposed to the rates on gross income, typically this flat rate is lower than the rate on net income. Now, why would that make sense?
It's big by gross receipts.
Yeah, gross receipts is higher. So if, in theory, a tax rate on net is to, in theory, be equivalent to a tax rate on net income, you would expect the tax rate on gross to be lower. And around the world, that's generally the case. You'll find a 10 to 20% rate on withholding tax, and then maybe 20% to 40% on net income. Now, interestingly, over the last, I guess, 25 years or so, especially since the Reagan years, when he significantly reduced the U.S. tax rate, and this, let's say, started similar reductions of rates in a lot of other countries around the world, the rates on net income. The average rates have fallen significantly over the 25-year period. But interestingly, there's been very little change in the withholding tax rates. So maybe it originally started because of this, let's say, concept of some sort of equality, but it's less that way now, because rates have generally come down on net income, but they haven't been touched on gross income. Okay, so now what about permanent establishment, where you have a permanent establishment? Again, we're saying non-residents generally taxed on limited categories of income at a flat rate on gross income and through a withholding mechanism. Now we look at those that have permanent establishments, and we say again, what is it? And it's that minimum defined level of activity as defined in local law or in an applicable tax treaty to determine when there is enough activity to such that that non-resident is considered to have a permanent establishment. Once it has that, then whatever income is attributable to that will normally then be brought into the tax net and taxed on a net basis at the normal rate in the country. Now notice this point over here. We'll get into this again later, but notice that the focus is on that there is a location typically where business is being conducted. There are assets, there are people, there's business activity going on. That is the focus you find in most countries. It is not based on the non-resident's legal status in the country. If a foreign corporation, let's say one from Japan, wants to set up in Washington, what do they have to do? Do they have to go into the Secretary of State and somehow qualify to do business here? Any ideas? Well, I don't know. I'm assuming that that's probably what they have to do. Now, whether they call themselves a representative office, which is a term we'll talk about more later, whether they call themselves a branch, whether they have a piece of paper that says they're qualified to be here and as a result can use the Washington court system, that legal status is not normally an issue in whether a permanent establishment exists. The tests, the things you look at are what are the activities, what are the people, what are the assets. Those are the things that make a difference, not the legal status. Now, having said that, yes, it is fair to say that in some countries, if you do go and register a legal status, even though maybe you do nothing, there are mechanisms where once you've registered, that information is given to the tax authorities, and they expect there to be a tax return being filed as a result. But that may be a practical application, but the tax laws in most countries do not look at that legal status. They solely make decisions as to what is taxable based on, or whether there's a permanent establishment, I should say, based on those activities, people, assets, location. Okay, what is taxable? Typically, you find either a term like in the U.S., effectively connected income, or you find the expression income attributable to the permanent establishment. That latter expression is what you find in most tax treaties. Okay, again, we've talked about the tax base being net income, because again, jurisdiction, there's enough activities, there's enough presence, information can be forced out of the non-resident to, excuse me, calculate a net income. You occasionally find in Asia a deemed income calculation. In other words, local tax authorities are either sufficiently lazy or sufficiently untrustworthy of what the foreign barbarians will tell them that it's a lot easier just to negotiate a rate, a flat rate on gross income to arrive at a net income figure and then apply the tax rate to that. So you're, in theory, getting to a net income number, but it's just either a negotiated or by statute percentage of gross income. Or in some cases, if the information that's most easily accessible is the cost of upkeep in the office, local salaries, rental, the local electric bill, and so on, that might be the basis for the calculation of the net income at some flat rate to which the normal tax rate on net income is applied. Okay, again, tax rate, typically the same rate is applied to resident taxpayers. Again, if we were looking at the U.S., the same corporate bracketed rates going up to 35% would apply to a foreign corporation that's conducting business in the U.S. Okay, individuals, we've been talking mostly about corporations, legal entities, but individuals, generally around the world, the same rules apply. Generally, the same concepts apply. I mentioned that, in an earlier slide, that residency was important because of the basis of tax and the rate of tax, which was what we've covered so far. And then the third item is the applicability of tax treaties. Article 1, this is from the China-U.S. treaty, is absolutely typical of most treaties out there. This agreement shall apply to persons who are residents of one or both of the contracting states. One or both. How could one person be resident of two countries?
citizen of one but resides abroad has
Well, you mean like an individual? Yeah, that could happen. Interestingly, the U.S. position is that if I, a U.S. citizen, reside abroad, I'm not a resident of the U.S. for purposes of the treaty. So actually for the individual that, at least for the U.S., would not normally be the case. But yes, you can have. Yes, Peter?
If one country defines corporate residency as a place of incorporation and another country defines corporate residency as a primary place of business.
Yeah, that's perfect. The point is different countries have different rules on what's resident. And as a result, if you're incorporated here but managed and controlled there, you might be resident in two countries. Now maybe you want to be resident in two countries. There could be situations where that's the case. But without going into detail on what situations might encourage that, let's just recognize that, yeah, it can happen. And the same thing for individuals. You can have two countries that have different rules on what residency is. I may live and have my family in one country, and I travel on business into another country so much that because they have a days in country calculation, they consider me a resident. For individuals, yeah, you see some countries that have a quantitative test, some that have a qualitative test. This is what we talked a little bit about before, location of formation or management and control. Management and control itself is a very fuzzy concept. The ultimate point, though, to determine residency, you must examine the rules of the country and the facts and circumstances of the company, its management, and its directors. So this is very much a factual-based thing. Do you think you can control the residency of a company if you really want to? Well, yeah, very often, yes, you can. So if you're, back in our example of Company X that had the subsidiary Company Y and we talked about how it might be attacked in one way or another, if we really want Y to not be resident in country X, country A, if we really want it to be resident in country B, we can look at the rules of country A. We can look at the rules of country B and attempt to make sure that we act in a manner which is consistent with those rules so that it's resident on a strong basis where we want it to be. So planning might well be beating on your client to follow certain procedures for the management of the company. Now, if this creates too much of an operational problem, well, then maybe that's not planning that is realistic for this client. But the point is, there's a tremendous amount of control if you can arrange your facts in the right way so that Andrew over here is happy as a clam when you show it to him. This is just an example of, again, what you see in another country. This is the Chinese income tax law effective from 2008. And it specifically defines resident as being either formed, established within China, excluding Hong Kong and Macau, or managed and controlled in China. Now, interestingly, I don't know whether it'll ever get, whether it'll ever see the light of day, but here in the United States, there have been, and again, I don't remember whether it's just in the website or it was one of the handouts, but there's a proposed rule in one of the bills that was introduced in Congress, I think, last year, which would change the U.S. rule that's been there for 100 years now, darn near, that a U.S. taxpayer is not only one that's incorporated here, but one that is managed and controlled here. Now, whether that will ever really see the light of day, who knows, but it's obviously a major, major issue if we do see a change there. This is as an example, when might the Chinese management and control test be a concern? You have a lot of cases, often called red chips, where you have a Hong Kong company, or maybe formed in another tax haven, but often Hong Kong. It's a publicly held company listed on some exchange outside of China, but the majority of its activities are through subsidiaries inside China. And in these cases, very often, the real authority in the country is inside China. So this has become a major issue as a result of this new tax act that came in 2008. Okay, I think what we'll do is when we come back, we'll do two things. When we come back next Wednesday, we'll cover this short case study, and we'll also do one thing that I forgot to do, which was when we were talking about the earlier case study, I said we were going to talk about it with the facts being at one end of the spectrum, and then we were going to talk about it at the other end. So we're going to do the other end next time at the start of class. Any questions or other things that you'd like to cover before you escape for the evening? Okay, well, it's been a pleasure. Have a nice week.